Should we buy or sell the gold miner ETF? First off, read this disclaimer carefully. Then do your good deed of the day by liking and subscribing. So, here is the GDX 7.77% from the 52-week low, magical number, minus 36.86% away from the 52-week highs. Just for comparison, here you can see the junior gold miners, silver miners, and junior silver miners. Let's just jump right into the charts. So yeah, here we have weekly data points. So we have seen a very substantial pullback. Yeah, a lot of people expected more from gold, given the current context, but gold is the mother of finance. It is a very tricky metal to fully understand, and those who fully understand it, they become billionaires, and probably will not share all the intel they know. But that is why it is so important to analyze this commodity. The thing is that this current level has been rather buyable historically, looking at this chart. If we zoom in a bit here, we can see that actually the last 3 weeks have been rather interesting here for the bulls, in that some kind of lowish formation is in development. If we go here to the daily data points, then we can see it a bit more clearly. So let me just draw in the purple 20-day moving average, because that is definitively the level to watch. It is a resistance level that has rewarded the bears, but it also is a level that is very important to the bulls. Hence, the coming week is going to be very important for the gold miners. So let me just zoom in here, because we did on Friday close above the purple 20-day moving average. We did goof around above the 20-day here in early June without much success. So that is sort of like the issue here for the bulls, is that yes, it is good to get above it, but you absolutely need to stay above it. The benefit now is that, so if you look here back in June, then you had, the big boy 200-day moving average right above us. That was like big deal resistance. In this case, I mean, the only like moving average resistance would be like the 50-day moving average, but that one is way above us. So if we were to travel up there, that would be like, approaching a 9-ish% move. And if we look here at, the weeklies, you have the 5-week moving average here, but it's not like a highly watched moving average. So basically, given that we have fallen down to this level where the bears don't have that much to look at, it actually is very beneficial here, because the bears are not going to feel threatened by the bulls having some fun, hopefully. Looking here, yeah, MACD is at an extremely low level. RSI is at a level that has triggered some healthy rallies in the past. Back here, it formed a low. Back here, that was actually a bit above the current level. This low here, as an example, let me just. It was here, yeah, during the C19 lockdown. Then the current RSI level was very buyable. Distance from between price and the purple 20-week and green 50-week and also blue 100 weekly moving average PPO, and also frankly the red 200 weekly moving average PPO, it is very buyable. Many times in the past, it was followed by a substantial rally. Here is the daily data points. What I don't like is that accumulation distribution is still a bit weak. Some improvements here on RSI. We have some sign of strength that is beneficial, but the bulls still have a lot to prove. So I write 20 daily moving average breakout, and we are oversold. So I give the bulls a 3 here on the technicals. If I was forced to pick a direction to be long or short the gold miners at this level, then I would feel less comfortable being short. I think that quite a few bears are going to lock in some profits and simply are not going to feel threatened at all by the bulls rallying a bit. So basically, things are so bearish that it is potentially bullish. Okay, so here we have seasonality. To the right here, in red over the last 10 years, we usually see a bit more weakness here heading into early August, but that is, beginning of next week. And then we have some decent seasonality. In green over the last 5 years, the seasonality is weak heading towards 1st of September. In blue over the last 7 years, we do see also the same thing. So to the left here, over the last 5 years, we do see that August and September are very weak. That is obviously not bullish. Over the last 10 years, then August is one of the stronger-ish months. It closes higher 56% of the time. On average, we do, however, have a loss, and September is the weakest month. Over the last 17 years, August is clearly one of the stronger months, but most months are not that strong for the GDX. But relatively speaking, it is bullish. The problem is that September is the weakest month. So I give the bulls a 2 here on seasonality because there is something interesting about August. The problem is September, the weakest month for GDX, and that increases the risk that we are simply going to see a bounce potentially for the GDX instead of a longer term low. September is what it is. We did look at quite a few years of data, and the data was very clear. September is bad, and that makes it more difficult for the bulls to go like big and heavy into GDX right before the worst month. Let's compare the gold miners ETF GDX with the SIL, which is the silver miners ETF. So going to performance year to date, we can see that the gold miners are substantially outperforming, relatively speaking, the silver miners. The beta is lower as well. PE is much lower. Yeah, but the dividend is substantially less than the silver miners, 0.55% versus 2.20%. Looking at the holdings, 55 versus 41. So here you can see the market cap breakdown. And these ETFs are very heavily leaning on America. 82% here and 86 with the silver miners. You can see that in this sense, America means primarily Canada. Canada is huge. Very, very much a big deal when it comes to precious metals. I give the bulls here a 4 on the fundamentals. This is a relatively low level for the gold miners. So it is possible that we will find some value hunters picking up some of the gold miners. So here are the correlations. Long term, we have 26% with S&P 500. We have 86% with gold, minus 31% with the 10-year yield, and minus 48% with the dollar index. So yes, there is a negative correlation between gold and the dollar index, but it is not like extremely negative because some people think it is like minus 1, which is obviously isn't. Here are short-term correlations, 42% with S&P 500, 96% with gold, minus 14 with the 10-year yield, And then you do have minus 43% with the dollar index ETF, UUP. So what happens with gold is unsurprisingly going to have a pretty substantial effect on the gold miners. So here is gold. The thing is that gold recently bounced from the very important red 200-week moving average. Extremely buyable back here. Was very buyable here. Just a beautiful entry level, and we are seeing some bounce here from this metal. The problem that I do see for gold here is that we are heading into some horizontal resistance. If we go here to the daily data points, yeah, we see that the level is right here above us. If we look at these other indicators, yeah, RSI is also, I mean, you could argue that this is also RSI resistance. On the dailies, I would ideally like to see more corroboration from accumulation distribution, because we currently see that this rally was on light volume. Here is the relationship between gold and the GDX. Yeah, so when we look at the RSI here especially, we see that these two, they move up and down. We have currently flown up to a level that usually leads to a bit of a pullback, which means that gold has a tendency to underperform the gold miners. That is, in our case, bullish. So that's interesting. Looking here at the seasonality data, like that. So in blue here, over the last 7 years, we usually see gold underperformed the GDX a bit here into early August. In green, over the last 5 years, we do see that the underperformance leads into September, which is beneficial for the GDX. And in red, over the last 10 years, yeah. Then generally speaking, we do see that from the 9th of August onward, gold usually outperforms being in the GDX. So I give the bulls a 3 here on relative performance. We end up with a score here of 3 in favor of the bulls. The key event is that we have a 20 daily moving average breakout, and we are emerging from a relatively oversold level. So the data is more favorable of bullish positions than bearish. Let's look at some other precious metals. So let's just do the SLV like that. Here is the silver ETF. The chart looks a bit similar to what we saw with the GDX. So a strong rally from silver this week, but we are heading towards a very important resistance level in the form of the red 200-week moving average. So how far is that above us? So it is, yeah, between 1 and 2%. So let's look here at the daily data points. In this case, you can see that the 50 daily moving average in green has become rather tradable. Here, very buyable. Here it became resistance, and we are very close to that one. So definitely have the 50-day also on your radar. Let's look at the silver miners. So in this case, we are emerging from a very low level. Historically speaking, looking way back here into 2010, we have spent more time above the current price level than below it. So the risk reward is more favorable of bullish positions. So it's interesting. Obviously, that doesn't mean that it has to get above it. It simply is a question of what does the average data suggest. In most economic conditions, we would expect silver miners to go higher. So let's look at platinum. Platinum is also, a precious metal, but it's one of those precious metals that is ignored by a lot of investors. So here is the futures. Yeah, we are at a very low level here as well. In this case, you could certainly argue that we have some solid resistance level back here. So this is it's going to be challenging for the bulls. Then again, if you were to break out above a very big deal resistance level, then that will be very spooky for the bears. But definitely on platinum, the bulls need a very substantial catalyst. So yeah, to get more data, just get VIP access on DiamondArm.com.